Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here at the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session on protection strategies, we'll look at puts, calls, and different spread types, as well as how to apply these approaches in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of the retail market to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, protecting your portfolio with option strategies. Joe?
Nick, thanks very much, and thanks to everybody in this busy season for joining us today for the OIC webinar. Our topic today, as you know, is protecting your portfolio with option strategies. Just to give you a sense for how we go about picking the various topics. Really, first and foremost, Nick mentioned the surveys that are available. We take those survey responses real seriously. One of the questions is, what would you like to hear? And certainly some of the feedback has been this whole idea of protecting your portfolio. So that's really the number one reason why we chose today's topic. A couple other reasons. We're at all-time highs, so it seems like a pretty good idea. And then certainly, if we look back 30 or 60 days, that month of October was pretty darn volatile with in some markets as much as a 10% correction. So that's why we picked tonight's topic. And again, thanks for joining us. I think most of you know that the industry puts out this characteristics and risks of standardized options document, which basically offers a lot of context as to the risks and benefits of exchange-traded options. So if you haven't received a copy of that, do reach out to either the OCC or your broker to get a copy of that. For those of you new to the OIC events, this is who we are. We are, a nonprofit educational entity funded by the members of the OCC, the Clearing Corporation, along with the now 12 U.S. listed option exchanges. And this really is, for those of you who have heard me in the past, this is one of my favorite slides. I mean, it speaks to the growth in the industry. We started in '73 at the Chicago Board Options Exchange, and now we've got, as I mentioned, 12 various exchanges. We're averaging on average close to 17 million contracts a day. We're on pace to likely have the second busiest year in history, averaging about 17 million contracts a day. So lots of business going on in the listed options world. When we talk about options, we talk about them being financial tools, and really they're just there are a few real reasons why investors, both retail and professional, use the listed options product, and primarily it's a tool to potentially reduce risk. The retail investor especially has been using options more and more to generate income in this low interest rate environment. Certainly there are some out there who use options for speculation, and with those different uses and forms, we do have a few unique trade-offs from a risk-reward standpoint. So this is a slide multicolored tonight. I actually we went in and we highlighted in dark the downside strategies out of the 18 that happen to be posted here, and we will review each of these strategies. As you can see, these lines represent basically the potential profit or risk in potential positions, just the positions themselves. And so we will review each of those dark strategies tonight. And the strategies that we will review include long put, short call, straddle, strangle, bear put spread, bear call spread. And we'll take it a step further. We're going to get into some synthetic discussion. Long stock, long puts, short stock, long call, short stock, short put. So, some of this I'm sure will be a review for some of you, but as we especially get into the synthetics towards the bottom there, maybe it'll be something that you're not familiar with. So really, a number of the slides we've generated from our wonderful tool that's on the website. If you haven't used it before, I would urge each and every one of you to take the time to get familiar with the position simulator. It is found under the headings on the main page of optionseducation.org, the drop down for tools and resources, and that's where you will find the position simulator. And as we go through a number of the strategies and concepts tonight, we will draw on the position simulator. Actually, I'm going to back that up just a little bit. Different areas in the position simulator. We're going to look at each of we're going to have a couple different lines, P&L lines. That's what this red line represents in this particular illustration. It's a long call position, but in ours, most of them will have two lines because we got a number of different multi-leg strategies, and so we'll go through that. But the position simulator allows you to basically show the P&L for each individual position. It allows you to do it in a composite fashion. It allows you to headline just delta. As you can see, there are lots of different capacities for multi-leg strategies. You have the capacity also to change the implied volatility levels, days to expiration, price of the stock, any number of different parts of your position and different Greeks can be adjusted in time, and that can really, it's just a fantastic tool to allow you to get a sense for where your option prices will go as the underlying moves up, down, or remains stagnant. So that's the position simulator under tools and resources on the home page. So I mentioned, the downside initiatives that we'll get into. We'll start with a long putt. Now, I think probably everybody, on the webinar tonight is familiar with puts. Puts, a long put allows an investor the right to sell stock at the strike price. That's what the right afforded by purchasing a put gives somebody. So one thing about long puts in terms of protection, it's essentially like buying insurance for your underlying stock or portfolio. Well, as we all know, insurance costs money. And that's one of the things in tonight's webinar that I want to kind of go back and forth on. You know, different choices in terms of how we can get protection, but do we get that protection by putting out money and doing different debit spreads, or potentially do we try to get some downside protection by putting on credit spreads and collecting money? So on the long put side, again, the long put is the right to sell stock at the strike price. That's going to be a form of downside protection where we're clearly going to be paying for that downside insurance. Depending on the size of your position in an underlying or your portfolio in general, you can use individual puts, you can use index puts, ETF puts. There are all kinds of different vehicles out there. I think actually on the 12 exchanges now, we are listing upwards of over 4,200 different products, all of which do offer puts. So, buying puts is clearly one form of downside protection. Key decisions when buying puts. How many puts do you need to protect yourself? How much time do you need? And basically, what strike do you plan to purchase in order to give you that downside protection? So there are three key questions that you need to ask yourself before buying long puts. As I mentioned, the position simulator here is just a long put, and you can see that red line as the underlying goes down. I think our underlying is $50, and we're long just one $50 put here. As the underlying goes down, the value of that $50 put is going to increase. And that, again, you can find out the delta, the expected value, all of those different pieces of information on the position simulator. So that's the long put side. On the short call side, we can gain some downside protection, but it's a completely different form of protection than a long put. And that's what I hope, we all understand. The short call does not afford us the same protection of the long put. The long put is the right to sell the underlying at the strike you purchased. The short call allows us to sell the underlying at the strike that we sell, but on the short call side, we can only protect the downside by the amount of premium that we take in for the call. So unless we're selling a very substantial deep in the money call against our positions, our protection to the downside is going to be somewhat limited. And that's a key difference between the long put, where we pay for insurance, versus the short call, where we are paid to potentially have the obligation to sell the underlying at whatever strike we sell. So that's long put and short call. And as you can see in the illustration through the position simulator, unlike the long put, where that red line continued to go up as the underlying went down, here that potential profit, that red line flattens out horizontally, because again, we can only make whatever premium we sold the call for. And you can see, once you sell the call, if the underlying turns and takes off to the upside, we have an obligation to sell that underlying at whatever strike price we've sold. So key differences between the long put and the short call. Both afford some downside protection. The long put significantly more than the short call. Again, depending on the strike you sell with the short call, you'd be taking in money versus paying for the insurance to the downside with the long put. Let's look at another choice for downside protection, the bear put spread. Now let's be clear for those of you who may just be starting out a little bit. What is a bear put spread? A bear put spread is where we buy one put at one strike and sell another put at a lower strike. Same expiration and of course same underlying. So because we're buying the higher price put and selling the lower price put, this is always a debit spread. So this spread, just like the long put, we're always going to pay for this downside protection. Why don't we take a look here in our example, coming off the position simulator. Again, the stock is at 50. We've got the 50-45 put spread. So the red line, you can see as the stock goes down to the left of that blue box, as the stock goes down, that 50 put continues to appreciate in value, where the 45 put that we're short, if the stock continues to go down, that will at some point start to become, more valuable, and therefore, will accrue losses, which will be offset by the long put. But let's talk now about vertical spreads, and we can talk about this example specifically. So we've got a $50 underlying. We're long the 50 put and short the 45 put. In our example, I think we're long the one put for a little over $2. We're short the 45 put for 41 cents. I think it's about a $1.65 debit for that spread. So it's the 50-45 put spread. We're paying a $1.65 debit for it. And again, for those of you new to spreads and maybe new to options, the maximum spread of that vertical bear put spread is the difference between the strikes. So again, it's the 50-45 put spread. The maximum that can be worth at expiration is going to be the difference between the strikes, which is $5. If we pay the $1.65, that means the max we can make to the downside in terms of downside protection is $3.35. If we paid $1.65 plus the $3.35 equals $5. So, in other words, we're long the stock at 50. If the stock goes down more than $3.35, we're going to have a net loss in the stock. And that's the protection that this put spread would afford, basically $3.35 to the downside. If we did the 50-40 put spread rather than the 50-45, we would pay more for the spread, certainly, but the potential profit at expiration for that spread could be up to $10. The difference between the strikes being 10 less the debit we paid. So again, the whole idea of what strike or strikes in the example of a spread, always very, very important. So the bear put spread can give us some downside protection, but unlike the long put, the maximum downside protection is defined by the difference between the strikes. So again, that's just we get into these various strategies based on our opinion of the underlying. Now, a bear call spread is similar in one respect, because a bear call spread, again, is a vertical spread, and some of the same tenets do apply. What a bear call spread is where we sell one call at a lower strike and sell another with a lower strike. Same expiration, same underlying. It's always a credit because we sell the lower strike call, buy the higher strike call, and that's what gets us a credit. And again, if we were to take that same example or something very similar, I think you can see where, on the call spread side, our example with the stock at 50, we've sold the 50 call and bought the 55 call. I think between the price of the 50 and the 55, we're doing this for $1.58 credit. So with the stock at 50 and selling the 50-55 call spread, if we take in the 158, we've given ourselves $1.58 of downside protection. Not a heck of a lot with a $50 underlying. But the idea here is just to give you a sense of, the various choices for different strategies that are possible, when trying to look at downside protection. And then getting back to that first question when we started, do you want to pay for your insurance and really have unlimited downside protection, or maybe are you willing to take in some credits and maybe not have quite as much downside protection? Another one of our choices tonight is the straddle. And as the slide to the right suggests, you can see that blue line. The straddle basically is the long call and long put. Same strike, same expiration, and of course the same underlying stock. So in our $50 call example, we're going to be long the 50 call and the 50 put. And clearly, being long call, long put means that we're going to have a position that as the stock moves in any meaningful way, our focus tonight is downside protection, that long put is going to give us, as much downside protection as we want and need until we decide that maybe the underlying is going far enough and we unwind the position. So in our example, you can see the long call, the red line, gives us potential profits to the upside. The long put gives us potential profits to the downside. That's the goldish line. Now let's just talk through the delta of a long straddle. Okay, what do we think? The risk in the long straddle may be, the biggest risk? Well, to me, it's really two things. One would be, clearly we're long a call, we're long a put, so theta is a risk. If that underlying doesn't move away from the strike, clearly those at-the-money options are going to lose significant value over time. So theta is a concern. And the other, thing to at least be aware of when you talk about positions, really any option position, but, especially when we're talking about long calls and long puts, you want to have a sense for what the implied volatility is. The higher the implied volatilities, the higher the time premiums are going to be. The lower the implied volatilities, the lower the time premiums. So it makes sense to have some idea of whether the implieds are at a midpoint, a high point, or a low point when you consider a position like this. In the straddle, in our example here, I think we've got a call that's valued at just over $2, $2.17. The put just over $2 at $2.06. So it's a $50 stock with about I think we've got about 55 days to expiration. The value of that straddle is just under $425, $423 to be specific. So as I said, that stock really needs to move in order to offset the theta, the erosion of that long call and long put. But in terms of downside protection, a straddle is, one form of not insignificant downside protection. The thing to think about, if we're talking about the 50 straddle, and we're talking about the stock at 50, ballpark, the call and the put both have 50 delta to get us to our 100 deltas with the stock at 50. If the stock starts to tank, and if that's the reason why we put on this straddle in the first place, stock goes to 45, the value of that put is going to, increase rather significantly, depending on how close we're getting to expiration. But, the value of the put's going to go from 50 to, maybe 70. The call value of delta is going to go from 50 to maybe 30. And as you continue to, as the underlying continues to drop, the delta of that put, increases. And again, the closer you get to expiration, the less delta you're going to have in the call. So you can get to the point where that the delta in that put can get up to 90 or 100 if it's deep enough in the money and we're close enough to expiration. So you can actually, be completely hedged if you are long one straddle versus 100 shares of stock. I think maybe a little later on when we get into the synthetics, we will talk about, when maybe you have more options than shares of the underlying, which would, of course, give you more gamma and more delta, depending on whether the stock's going down or up. So that's the long straddle. The long strangle, again, is a position that is long call and long put. But notice the difference, in the P&L graph to the right. Rather than the maximum loss point being at one specific point, on the vertical axis, you have a line straight across. So there's a much greater range at expiration where you can lose the debit paid for that strangle versus, that specific 1 point with the straddle. And why would that be? Well, the reason is in a strangle versus the strangle has an out-of-the-money call and an out-of-the-money put. So the distance between those two strikes is represented by this horizontal line below the break-even point. But again, now, this is at expiration. So, again, this strangle, just for those, who may be getting started, both options have to be with the same underlying stock, always the same expiration month. The call is going to be, an out-of-the-money call, typically, and the put will be a lower strike out-of-the-money put. And as you can see, our long strangle will have a significantly lower debit than the price of that straddle. And again, that gets into understanding the differences in the risks, where the rewards come in. When we put these strategies on, there's no rule that says we need to hold them till expiration. It's critically important to know, what the function will be and what the net position will be at the end of, the expiration cycle. But by no means do we need to, buy this thing with 60 days to go and hold it for 60 days. If we get a move in the stock and we get a pop in that option position, we are free to, take those profits in the option position that maybe offset, a loss in the underlying, or just, give us an additional profit on top of, what may be going on in the underlying. So with the strangle, because it's a wider range than the straddle, the debit is going to be significantly smaller than the debit for the straddle. In our example, the total debit, the call's just under 60 cents, the put's just over 40. Our total debit is $1 for the, again, with the stock at $50, we're long the 55 call and the 45 put. So again, significantly lower debit. Ideally, we get into, again, with really any option position, whether you're buying or selling options, try to have a sense for whether the implieds are at a midpoint, a high range, or a low range. That's just to your advantage to really know what level of time premium you're buying or selling. And The strangle can be a less expensive, important form of downside protection against a specific stock or an overall portfolio. So let's talk synthetics here a little bit. Long stock, long puts. All right, and you can see the white line, in the position simulator slide suggests the long stock position. We make money to the upside, lose money to the downside. The red line represents the put position, and you can see that red line to the right goes horizontal, so we can lose whatever debit we paid for that put. In this example, we're long 500 shares of stock and 5 puts. So we can lose the debit paid for the puts if the underlying goes nowhere. If the stock moves to the downside, you can see 5 puts versus the 500 shares of stock will eventually offset itself and give us, complete downside protection. So that's long stock, long put. The other thing about long stock, long put, what happens to the upside? And I know, this is a webinar on downside protection, but as a byproduct and a potential bonus, the long puts at some point, they've got a particular price, and a debit. I think in our example, these puts are about $2.04. So as soon as the stock, if we happen to be wrong in our prediction or our forecast that the stock was going to go down, if the stock turned and took off, anything above 50 plus the premium paid for the put, the 204, anything above 5204 could potentially be profit for us, because the long stock can go up to infinity. What we can lose on the long puts is just the premium paid. So that's 500 shares of long stock and long 5 puts. Now, the whole idea of synthetics here, this next slide is an example where, we're long 500 shares of long stock, but we're also now long 10 of the puts. And you can see where the red line starts to go up a little bit more towards the sky. So, long 10 puts, we would have, and those things are valued at just over $2. So we've got basically a roughly $2,000 investment for the puts. So we're long 500 shares of stock at $50 and long 10 of the Jan 50 puts for $204. So just think, please, conceptually, if the stock starts to head south in a meaningful way, again, we're talking downside protection at 50. Those options are going to have about a 50 delta. So at 50, we would be about delta neutral. If the puts have 50 delta, 10 times 50 is going to be 500. We've got the 500 shares of stock. So that's why we're delta neutral. If the stock just lays around at 50, what hurts us? Well, theta hurts us, because the value of those puts is going to erode as we get close to expiration, and they can erode to the tune of our debit, which was just over $2,000. But now, if we are right in our forecast and the underlying does start to head, to the downside, those puts, let's say the stock goes to 47, 46. At 47, those puts are worth $3. $3 intrinsically plus any time value that's left, and at 46 they're worth $4, and so on. As we continue to go down, the 500 shares is the 500 shares, but rather than 5 puts to offset the 500 shares of stock, we potentially have downside profit potential as these long puts gain delta to the downside. So from a delta perspective, at 50, we were delta neutral. As the stock drops and we get closer to expiration, those puts gain in delta, so we are getting shorter as the underlying goes down. And so at that point, you've got, depending on what your approach is, you can stay short, You can sell out a few of the puts as we go down. Never more than 5 puts do you want to sell, because the 5 will always protect your 500 shares of stock. The other thing you could potentially do is buy up to 500 shares of stock to get to the point where you're 1 for 1 with these puts that are now in the money and maybe close to expiration. But that's where, again, the position simulator can allow you to simulate what the delta will be as we get closer to expiration and as the stock, goes up and down. So that's 500 shares with 10 puts. This last slide, you can see that red line is a little more abrupt to the upside. This is 500 shares versus 15 puts to the downside. Clearly, with each example, we are paying more for insurance. And, the insurance with 15 puts at just over $2 is going to be, just over a $3,000 commitment for that downside insurance. And that gives you, lots of potential if the stock goes down, but again, knowing full well that if the stock either goes up or just sits around that strike, you have risk of losing the time premium on those long puts. So that's long stock, long puts. Let's take a look at short stock, long call. Short stock, long call, also known as a synthetic put. And maybe we're throwing some new terms out there for folks tonight, but, the synthetic put short stock long call position is one that, a lot of different traders on the floor would certainly use. And a short stock long call position is a positive gamma position, so it costs you, from a theta perspective, it allows your delta to get short on the way down and long on the way up. We got a couple examples of that here, similar to the long stock, long put position. We're short 500 shares of stock. That's represented by the white line, and then the long calls are represented, the P&L is represented by the red line. So obviously if the stock were to go against our forecast and go up, we would have some protection. We'd have ultimate protection, actually. The short stock would be covered by the 5 long calls. Our risk would be the difference between the price we paid for the long call versus the price where we sold the stock. And that essentially is this synthetic put. And the reason it's called a synthetic put is we pay a debit for the long call, just over $2. And so if the stock continues to fall, just like the put, where the long put, long stock position, as the stock went down, the long puts increased in value. The short calls, as the stock goes down, decrease in delta. The short call decreases in delta as the stock goes down. So at some point, depending on whether you sold a deep in the money call, an at the money call closer to 50 delta, or maybe even an out of the money call, at some point those deltas are not going to hedge that short stock if the stock continues to go south. And that's why the term synthetic put. If the stock were to really go, down significantly, in essence, we would just be short stock with an ultimate long call protection, to the upside with the long calls. And, from a numbers standpoint, here we're 500 shares short versus 5 long calls. Our next slide, we're basically still short that 500 shares, but long now 10 calls. And again, this is, a bigger commitment, obviously, from a delta perspective, as well as a debit and investment perspective. But, that's the beauty of using options, and a great area of potential fun trying to figure out what makes the most sense. And, on slide 29 here, we've got 15 long calls versus short stock. So clearly, the more calls we're long, the more upside, potential we have. But in terms of our downside protection, this is still a synthetic put. It's just depending on your ratio, the more calls you have, the bigger your debit, the larger the stock is going to have to fall before you have your break-even point, or actually get to the point where you are making money. So even with the ratio greater than 1-to-1, because of how the position is made up, you can still certainly make money to the downside even when you have a ratio of long calls versus the short stock. And the last position we want to talk about is short stock, short put. Another synthetic, so we're short stock and short put. Short stock, obviously we're looking for the stock to go down. Short put is, when we sell a put, it's the potentially we have the obligation to buy the stock. So in essence, this short stock, short put position is a synthetic short call. And, we can approach it the very same way. The position simulator, the white line, shows us short our 500 shares of stock, short the 5 puts, basically gives us a 1-for-1 offset. So as the stock heads down, ultimately that short put, as it goes through the strike price and beyond the credit taken in for that short put, they're going to offset one another. Now when we get into, and that's a 1-for-1 here, short 500 shares of stock and short 5 puts. We got to be very careful because, again, this is downside protections that we're talking about. And if we get into a position where we're talking about being on a ratio, selling 500 shares of stock, but selling 10 puts, we've really gone against the whole idea of downside protection, because our potential obligation is to get longer as the stock goes down by selling stock potentially short and then selling the puts. If we exceed that 1-for-1 ratio, the obligation that we have is to buy stock at the underlying. And of course, buying stock when the market goes down goes against the idea of having additional downside protection. So there are, I think that was 7 different scenarios we wanted to run by you tonight for downside protection. Again, the reason for picking this tonight was really first and foremost because of the feedback on the surveys that we get from all of you attending, and we do appreciate that. Before we go to questions, this slide, for those of you who are new to OIC and especially to options, on the website we have a test. Basically, it's an assessment test to allow you to find out where you stand in terms of your option knowledge. And many of you probably know already. You're either beginners, you know a decent amount, so maybe you're intermediate, or rather advanced. Well, if you sign up for MyPath, it'll be a 20-question assessment. We will basically tell you at what level you are in terms of your option knowledge, and we'll turn around and download lessons for you at that appropriate level, right after you take the assessment. So do check out MyPath. You can find that on the homepage. I think many of you know optionseducation.org is our website. 888-OPTIONS is where our wonderful investor services team resides to answer all your questions, either via phone, text, or any other way. We have a mobile app as well as our YouTube channel. So lots of different ways to give you the opportunity to learn more about options. And I guess with that, Nick, I'll turn it over to you for some questions.
Great. Thanks, Joe. Ladies and gentlemen, to remind you, if we are not able to get to your question today, feel free to give our investing professionals a call at 888-OPTIONS. As Joe mentioned, they're there during business hours to take your calls, and would love to walk you through any of these option strategies that we discussed today. So, Joe, one of the things that you mentioned earlier was that we have people of varying activity and interest and ability levels here in the options space. And we did have a couple questions on some terminology regarding the term synthetic. Can you go into a little bit more description on what synthetic means in the context that you were using it?
Sure. Synthetic is, we all know what synthetic is. It's another way to create something, another form of making a particular product. Well, when we talk about a synthetic put, what we're talking about is, in essence, it's a put, but it's not. You don't get that put or create that put by just buying the put. You create that put by a couple different option positions. And, on the synthetic put side, it's the short stock, long call. And that's how we create a synthetic put. There are lots of different synthetics and different option strategies and positions that can be created by using a number of different calls, puts, and underlying combinations. And that's what we mean by synthetic, Nick.
Great, thanks, Joe. This is going to go back to one of your famous "it depends" scenarios, but I think we got to ask it anyway. Is there a best protection strategy? You talked about 7 of them today, but is there one best that our listeners should be looking at?
Sure, Nick, the one that makes you money. But to be serious, is there a best downside protection strategy? I think without question, the answer is no, there is not. I mean, obviously the goal is to protect and maybe, additionally generate some additional profits to the downside. But it gets back to the investor themselves. What types of risks are they comfortable with? How strong are they in their beliefs of an underlying going up, down, or sideways? So unfortunately, Nick, it does depend. What I would urge our listeners and participants is just try to study and get comfortable with 2 or 3 bullish option strategies, 2 or 3 bearish option strategies, and then even 2 or 3 neutral option strategies. Because after all, option prices depend on where the underlying goes, and the underlying, we can only be bullish, bearish, or neutral. So with so many options, strategies and ways to get long and get short, try to pick 2 or 3 that match your risk profile, and then apply them to your overall underlying positions when you are bullish, bearish, or neutral.
Joe, is there an advantage to doing a bear debit spread versus looking at a bear credit spread? Can you go into more detail on that?
Yeah, no real advantage, Nick. I mean, obviously on the credit side, and actually next Tuesday we will have our last webinar of the year. We'll discuss vertical spreads. So we'll get into this in some more detail. But there is the value of the call spread versus the put spread. Should be the same. If you've got that $5 difference between strikes, if the call spread's worth 2.5, the put spread's going to be worth 2.5. Doing a debit spread versus a credit spread, the markets these days are so efficient. Very seldom do you get the value of those spreads to get out of line. So I think on the credit side, you obviously get money put into your account, where on the debit side you have to put money out. It really just depends on what approach the investor wants to take.
So here's a question that just came in, and I know this is going to be a little bit varying depending on the broker or the people that they're going through. But this listener wanted to know: should you always protect your long stock position, or do you usually see your profits get eaten up by premiums?
Well, should you always protect your long stock position? There's no way that it's fair for me to answer that in a general sense. I mean, again, so often, and you referenced earlier the old "it depends." It really comes down to, what do you as an investor believe? And obviously, if you're bullish, you're not going to worry about downside protection. If you are bearish, the question is, do I get out of the market? Do I buy protection with options? It really gets back to if, knowing different option strategies, for somebody, and we didn't get into it tonight, I almost added it, but I thought that 7 strategies was enough. The whole idea of a collar, I didn't get into, but a collar would be a strategy where if you've got profits in an underlying, you can get downside protection, and depending on the strike prices and the premiums in the put and the call, you can lock in potential profits by selling an upside call, buying the downside put. The long put gives you the right to sell the stock at the strike where you're long that put. So that's the protection, for the downside. And you can offset the value of that put or the price of that insurance by selling the upside call. So depending on what strikes you pick, depending on, the skew in the market, oftentimes out of the money calls will have less premium than out of the money puts. But you can, incorporate some downside protection via a collar without paying, without just buying puts outright. So again, it sort of gets back to what's your risk tolerance, what's your opinion of the underlying. If you want downside protection, how do you want to go about it? Do you just want to buy puts? Do you want to sell a vertical call spread? Do you want to do a collar? And that's where building your options knowledge will help you be able to make those decisions, and decisions that are most comfortable for you, your portfolio, your asset base, and your risk tolerance levels.
Thanks, Joe. Another question we had is, how do you decide if you want to protect your portfolio with a strategy that costs money paying a debit, or protect it when you take in a credit?
Well, I'm repeating myself quite a bit in some of these answers because it really gets back to, more often than not, and not certainly all the time, but oftentimes, and I hope I'm not overstating this, when we pay a debit, and I mean it's not necessarily true when we talk about a vertical spread, but depending on how you, depending on the position you create with the debit or credit, is going to depend on the amount of downside protection you get. We get into those synthetic puts where we're short stock and long calls, where we're long stock and long puts, more than 1-for-1 with the stock. The more long options, or the greater number of long options, the greater the debit's going to be. I think, again, it gets back to this idea of how much downside protection do you think you need? What is your forecast suggesting on how far the underlying is going to get down? And then, you can look to see whether or not something like a vertical call spread, will give you adequate downside protection. Of course, selling a bull call spread will create a credit versus a position where you're putting out money in the form of long puts or a debit put spread.
Joe, you've talked a lot about downside protection here, and this might be another one where you may have gone over this already, but shouldn't a collar strategy also help protect your downside?
Well, yeah, I did kind of touch on that whole idea of the collar. And again, for folks who aren't certain what a collar is, it's a 3-leg position: long the underlying, long the put, which gives you downside protection, and then short the call, which can ultimately force you into the obligation to sell the stock at the short strike at expiration. So it's long stock, long put, short call, depending, and typically, not always, but typically that is done in the same expiration months. The key in putting together a collar, well, oftentimes the collar is put on after there's been an appreciation in the underlying. So oftentimes this thing is instituted with gains in place. The key then is deciding, how much of a debit or credit do you want to either pay out or take in around that gain in the underlying, and that debit or credit is going to depend on the strikes that you choose, how far, whether you do at the monies. More typically, it's an out of the money put and an out of the money call. The put being on the long side or purchased, where the call is sold to offset the price of the put.
Great, thanks, Joe. And we are coming up against the end of our session, so we have time for one more question, Joe. And this, I think, is from a more seasoned investor who wants to know about implied volatility as it pertains to some of the things we've talked about today. So does implied vol play a part in some of these strategies that you've talked today? And then how do you look at implied vol when you're trying to deal with multitudes of different strategies and positions?
Well, thanks to the listener who asked about implieds. For those of you who have heard me in the past, to me, implied volatility there's nothing more important than implied volatility when it comes to understanding option prices. So, the whole idea of debit versus credit, some of these positions today more certainly were long options for our downside protection versus short options. But either way, when it comes to implied volatility, and let's just quickly review, the couple kinds of volatility. Historic volatility, I like to call it the personality, the underlying. How much does it move? It's a fact, it's a statistic that tells us how the underlying has moved in the past. A little, a lot, we can know exactly how much given the historic volatility. The implied volatility, now typically implied is a level of movement generally a little bit higher than historic. That's typical, and that number is the market's consensus opinion for how much this underlying is going to move in the future. So as an example, we get into earnings, there's uncertainty in the market, implieds generally go up because of that uncertainty. As implieds go up, there are only two parts of an options price. We've got intrinsic value, and intrinsic value would be the in-the-money amount that may or may not exist. If the option's at the money or out of the money, there's no intrinsic value, so the entire value of that option is the time premium component. And by and large, the biggest factor driving, the level of time premium is implied volatility. When implieds are low, that means the market's expectation is that the underlying is going to move not too much. Therefore, the time premiums are less. When the implieds are high, the opposite is true. So it only makes, common sense that if you're going to start buying strangles, straddles, long puts versus long stock, you really should know, or just buying, puts by themselves. You should have a sense for whether those implieds, therefore the time premiums, are at a high, kind of mid or low point. Now, that's not to say you're not going to pull the trigger anyway. Whether they're, even if they are high, you want downside protection, you go do what you got to do, but at least have a sense, where these premiums are. So, in all aspects, Nick, of trading options, whether it's downside protection, no matter what you're doing, with listed options, do try to take the time to get a sense for, what the implied volatility levels are now versus where they've been. And again, going back to our website at optionseducation.org, the drop down under tools and resources, you'll find the historic and implied volatility charts that give you that data over the last year.
Joe, thanks for the detailed explanation. I know some of our listeners are very interested to hear more about volatility and how it pertains to them. Do you have any closing thoughts for our attendees today?
Well, maybe we'll have to do a volatility webinar in 2015, which I'm sure we will, Nick. But really, I just want to thank everybody. It's a very busy time for most investors, and just want to thank people for participating and hope that they'll join us next Tuesday and in 2015. And one last thing, if they like what we're doing, hopefully they'll tell their friends.
Joe, thanks again for your time and your expertise today, and same to you, ladies and gentlemen. Thank you for attending. Joe mentioned the position simulator, and that's available under the Tools and Resources drop-down on the OIC website at optionseducation.org. As I mentioned, today's session will be archived and accessible in a few hours using the same link that you used to join us today through the On24 system. Additionally, our 2014 webinars are available on the OIC YouTube channel, so you can review a number of option strategies and concepts at your own pace. Again, thank you for your time, and while we weren't able to get to all of your questions this afternoon, we have our Investor Services desk ready to help at 1-888-OPTIONS. Feel free to reach out to them. Ladies and gentlemen, we'll be holding our next webinar 1 week from today, our final one of the 2014 season, when Mr. Burgoyne will return to present on the topic of vertical spreads, as he mentioned. Make sure to check optionseducation.org for details on how to sign up. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.